rising oil prices are bad news for drivers and the Fed, as benchmark crude is up 21% in just the last 6 weeks, Ken. We've been seeing it creeping higher on oil. And I wonder what you do with that. Do you buy oil stocks here? Do you pull back on stocks because you worry that this is the underlying issue for inflation and it's still spiking?
Right, it's funny. So we're growth managers. You usually don't find ourselves in energy, but we are. We're actually dipping our toe into it. We think a better way to play it, though, instead of specific stocks like Exxon, Chevron, that stuff, is buy the basket ETF IYE. It trades a 3.5% dividend. Also, you'll find all those integrators in there. And again, as far as going forward with the market, we've taken a little risk-off position here. Again, we're not bearish. We just want to take some chips off the table. We had a blistering June and July, no doubt, right? And August, here comes August limping in. And then you get the Fitch downgrade, rates go higher, offer competition to stocks. But Marie, the biggest catalyst we believe for us to want to take some shekels or shillings off the table, so to speak, is that we saw the VIX, the volatility index, which was flatlined most of the summer. Maybe complacent, one could say, but definitely broke out of that range last week dramatically. Actually, the VIX is up again this morning. So to us, we're going to take some chips off the table. Again, that's not a bearish view. I think long-term constructive. But we do think there's a correction. It's nice to have some powder dry, have some money on the sideline, be opportunistic when and if that market comes to you.
Ken, what's your timing on that? I mean, look, Congress is out of session right now. They're not coming back until the week of September 12th. Obviously, Donald Trump and the Biden influence peddling, all of this is dominating conversations right now. But what will be the focus for markets when everybody comes back in September, do you think?
Right, so we just ended the quarter, and hopefully it was a decent quarter. But again, as I mentioned, there are some headwinds that are creeping up. This Fitch downgrade, all of us want to dismiss it very quick. Oh, it's Fitch. But they're telling this, they're signaling to the Congress, you can't keep going like this. It's unsustainable. It's like, you have an equity line on your house, and you keep going above the value of the house. That's pretty much where we are. I mean, think about it, $1 trillion a year to service the debt. Now, they're not going to be talking about that, right? They'll be talking about everything but that. And again, some of the things we spoke about inflation falls on the administration here, the spending and nonstop spending. So when they come back in session mid-September, expect a lot of, positioning and so forth, but nothing's going to get done on that. And the market's still not going to like this idea that, message delivered but not heard. And that's really what Fitch sent out.